The regulatory changes that started with the financial crisis aren't over yet. Understand these implications, risks, and requirements so you can focus your investments to better drive performance.
Brian, what are the major state and local tax, legislative, and regulatory trends you expect to see that most affect the financial services industry?
First, in the current political environment, we expect to see continued regulatory pressure on large banks and financial institutions. This will lead to private equity, hedge, and real estate funds becoming a more dominant source of financing for transactions in the future and becoming even more involved in commercial and residential debt through the use of partnership, business development companies, and real estate investment trust structures. Secondly, we expect states to seek to tax carried interest. Historically, this income has been sourced to the location of the domicile of the individual because it consisted of interest, dividends, and capital gains. However, we expect the states to treat this income as apportionable business income sourced and apportioned. Under these rules, taxpayers will need to ensure that they can properly get a resident tax credit in their home state.
In addition, states are expected to decouple from federal tax treaties and opt for a worldwide approach to determine taxable income. That complicates state filing exposure for taxpayers.
In the asset management space, we have seen significant use of treaty-based structures to mitigate effectively connected income, or ECI. So taxpayers need to be aware of the potential state tax exposure related to foreign income and activities.
But these constraints will be offset by tax relief elsewhere to keep the tax base from shrinking.
We expect that states with high personal income tax rates will seek to repeal their estate or inheritance taxes. We also expect a trend towards lower personal income tax rates to incentivize residents to remain in state. We expect the tax burden to shift to business entities, either through the use of unincorporated business taxes or sales taxes, especially out-of-state entities through the use of economic nexus and market-based sourcing legislation.
How should financial service companies prepare for these changes?
Financial services companies need to ensure that decision makers are working hand in hand with their tax departments. Tax departments must be proactive in analyzing these state tax trends to plan around domicile issues and ensure that their business structures are mitigating state tax exposures and risks.
Anticipate and act. PwC helps you to navigate a rapidly changing tax environment.